What is up, everybody? My name is Ben Beeman and welcome back to another video. Now, there are many opinions about where the stock market is headed in 2023, and it's interesting because last week I actually saw a poll on the Wall Street Bets Instagram page where millions of people voted where they thought the market was going to go in 2023. Now, after 24 hours of this voting, and like I said, millions of people were involved in this, the poll actually ended 50-50. Now, this just goes to show that there are a ton of different opinions out there, and people are basically split on where they think the market is going to go. Now today, I'm going to be breaking down my opinion on where I personally think the market is headed in 2023, but on top of that, I'm also going to be giving you guys the reasoning and the evidence behind my opinion so that you can form your own opinion on where you think the market is going to go. Now, if you guys do enjoy the video, I would really appreciate it if you would hit that subscribe button. It's 100% free and it means a ton to me. Now, many of you guys know that 2022 wreaked absolute financial havoc on the stock market. The Dow Jones ended down 9%, the S&P 500 ended down 19%, and the Nasdaq ended down a whopping 33%. What's done is done, and that's history now, so the big question is, will stocks begin to recover, or are they going to continue to fall? In order to make this prediction about whether they're going to continue to fall or whether they're going to recover, we need to understand why they have fallen previously. Now, this decline in the stock market is largely due to effects from the COVID-19 pandemic, so let's dive a little bit deeper into that. Many people do tend to bring politics into these economic discussions. However, I'm simply going to provide you with the facts, and you can draw whatever conclusion you'd like from those facts. Now, when COVID began in late 2019 and early 2020, the world shut down very quickly. In wake of this, the United States also had a presidential election, and on November 3rd, 2020, Joe Biden became president of the United States. By this time, we were deep into the COVID pandemic, which had caused lockdowns around the world. Now, these lockdowns led to the shortages of many essential goods, which led to shortages of things like tampons, cars, computer chips, and many other essential items. Now, on March 27th of 2020, President Trump signed into legislation the CARES Act, and this act dedicated $900 billion towards COVID-related economic relief in the United States. Now, this was put into place to avoid further economic meltdown due to extended lockdowns which we were experiencing at the time, and the CARES Act gave money and loans to passenger airlines and other businesses which were heavily affected by the pandemic. Now, once President Biden did take office, he continued to pass similar COVID relief bills costing the U.S. trillions of dollars. Considering the fact that this government spending was on top of normal U.S. expenditures, it was clear even at this time that spending this much money would not come without consequences. One of the major consequences of this government spending was major inflation. Earlier this year, the United States saw their consumer price index top 9%, which is the highest inflation has been in decades. The Consumer Price Index is a tool that tracks prices of various goods across the United States, and is generally used to approximate how bad inflation is for a year. Now, in order to combat this extremely high inflation, the Federal Reserve has been raising interest rates. Now, higher interest rates make it a lot more expensive for people to take out loans on things like cars and houses, this meaning that less people will end up taking out loans, considering the fact that they won't be able to afford it, and this is just simple supply and demand. Now, these high interest rates, coupled with the shortages we were talking about earlier, are affecting a lot of the companies in the United States, which in turn has a major effect on the economy as a whole. Now that we've unpacked why the economy has taken such a large hit over the past year, it's time to dive into when the economy will start to recover and heal. Now, the average length of a recession in the United States is about 10 months. However, the cause and the length of each recession is different, and we see this through the fact that the last recession we experienced occurred in 2020, and it only lasted about 2 months. And this is compared to the one before that, which occurred in 2007 through 2009, which lasted 18 months. If we do enter into a recession, a big indicator of when things will begin to get better is when both the consumer price index returns to about 2%, and on top of that, the Fed begins to lower interest rates. It is very key that both of these things happen around the same time, considering if the economy gets too bad, the Federal Reserve may begin to lower interest rates as an incentive for people to borrow and spend money just to stimulate the economy from getting worse. Now, if the Federal Reserve did do this, it could lead to inflation getting worse again and could prolong the recession. If the Federal Reserve did not lower interest rates once the consumer price index went back down, economic conditions would likely stay bad, considering people would still be more hesitant to borrow money, considering interest rates would still be very high. Now, the first one out of these two situations would be a lot more likely to happen, and this is because the Federal Reserve would not really really have a good reason to restrict the economy if inflation was not as high as it is right now. With all of this being said, we are already starting to see the consumer price index come back down. However, we are still very far from that 2% goal that the Federal Reserve generally likes to see each year. I personally believe that the Federal Reserve will be a little bit more flexible with these rates around mid to late 2023. Now this is because, like I said, the consumer price index, it's already beginning to drop, and the more we see this drop, the more flexible they will be. Now I believe that around fall of 2023, we will begin to see the stock market recover a little bit. Now this does not take into consideration a lot of unexpected events that could occur, and these unexpected events could rapidly change the direction of the stock market. Now an example of one of these unexpected events was the COVID pandemic. At the beginning of 2020, nobody expected the pandemic to be a big deal, and it was really just in China. But then by March, COVID was a global pandemic causing lockdowns and economic havoc across the world. So I really hope that this video helped to explain my opinion on current market conditions and the future conditions of the stock market. And in addition to that, I really hope that I elaborated on the reasoning behind my opinions and helped you to form your own opinions on what may happen in the future. Despite the fact that I do see the stock market dropping in the short term, I am continuing to invest my money, and this is because I am a long-term investor and I see a lot of potential for the US stock market in the future, so I basically think of me getting stocks at a discounted price. Now if you did like this video, I would really appreciate it if you would leave a like and you would subscribe to the channel. I do post 2 new videos each week that you're not going to want to miss out on, and I hope you enjoyed this video, and I hope to see you guys in the next one.